Welcome back to Accounting Matters. I'm Adam Olsen, Head of Firm Quality at Embark, and today we're unpacking the insights, challenges, and takeaways from the 2024 AICPA and CIMA Conference on Current SEC and PCAOB Developments. Joining me again is Nicole Harger, a Managing Director in our National Quality Team. Welcome, Nicole. It's been a minute since we've, sat down together and had some conversations.
It has.
But I know, we just got back not too long ago from DC after 3 action-packed days.
Yep.
And definitely felt like there was a lot of great conversations. Wouldn't you agree?
I do. Between evolving SEC priorities, PCAOB inspection trends, FASB standard setting updates, and conversations on emerging issues like AI, crypto, and ESG reporting, there's an incredible amount for companies to process and also plan for.
Yeah, and Embark was proud to attend again, like I said, as an underwriter of the event. I think it's our 3rd year we've done this and look forward to it every year. So we were definitely right in the middle of all that action. So we'll on today's episode, spend some time kind of walking through a lot of those key areas, key insights that were shared, takeaways that we observed being attendees there, and share that with you, our listeners. So let's go ahead and just kind of dive right into some of those key takeaways and next steps, starting with, I think, kind of the opener for the conference, which was really around kind of the shifting regulatory landscape. That was kind of the headline opener on day one. So Nicole, Commissioner Mark Uyeda and Congressman French Hill spoke in kind of 2 different sessions, but they didn't shy away in their conversations around the significant changes on the horizon. Mark, for example, focused heavily on capital formation and kind of the SEC's role there, pointing out how the regulatory environment has become burdensome for public companies. His argument, I feel like, was that we need a healthier balance between, the views on investor protection, but also kind of what is the cost of all that compliance for companies.
Right. And it's not just capital formation, right? Mark also touched on climate disclosures, with the SEC's final rule still stalled due to judicial review. He did suggest a move toward more principle-based, materiality-driven standards. His point here being that a shift to this mindset could reduce complexity, but still holds companies accountable for disclosing material climate-related risks. He also brought up crypto regulation, where the SEC's enforcement-based approach has created uncertainty. Mark and Hill both advocated for clear and comprehensive rules.
Yeah, and Hill, he went even further, suggesting kind of in the realms of the PCAOB, possible restructuring of their oversight as well, and maybe bringing that in under kind of the SEC. And while we don't know whether or not that viewpoint will gain any traction, I think it just really kind of signaled the broader appetite that with this change in kind of regulatory regime, just maybe more streamlined oversight. So kind of more to come there. But I will say for companies, if they're thinking about just some kind of key considerations around this kind of shifting regulatory environment, one on the climate disclosures, like you mentioned, so even if those rules change, I think a lot of people are of the viewpoint that the SEC climate rule may kind of fade into the background here. There still is a strong investor kind of expectation around climate-related information. We're still seeing that from an international front, as well as just kind of a voluntary front, that investors are looking for that information. So I think companies should still remain focused on kind of on their journey towards providing that information, or complying with international rules, if applicable. And so, things around enhancing data accuracy, controls around that information processes, and really kind of just preparing for that reporting if you're pulled into that umbrella of requirements, keep that top of mind. Crypto, like you mentioned, if you're dealing with digital assets, taking a proactive look at valuation, your accounting policies, and, related disclosures. I think companies are really starting to formalize more governance and kind of really understanding the impacts of how crypto is playing into their businesses. And then just from like the capital formation, so around the IPO readiness, if you're a private company and you've been kind of stalling your journey towards maybe going public just because of the prior kind of market atmosphere, we are kind of starting to see the window open for a lot of companies, really kind of moving towards more of those transactions that were penned up. So really just kind of understanding like maybe how some of these regulatory changes on the horizon could impact your journey towards becoming a public company.
Yep. And I think, just one additional point, companies need to stay engaged, right? The
Sure.
SEC is actively seeking feedback. They want and expect input. And so now's really the time to help shape practical investor-friendly regulations.
Yeah. All right, so let's move on to kind of the next kind of key area and get into Paul Munter, so chief accountant, and his remarks and insights from his office of the chief accountant and what they shared there. I think it's always an interesting session to kind of just hear his viewpoints on things, and I don't think this year did not disappoint on that front as well.
No, it didn't. I know it's one you and I always look forward to sitting in. So, consistent, I would say, with some prior years, right? His message is still clear. The foundation of financial reporting is trust and independence. Mm-hmm. The OCA is increasingly focused on ensuring preparers and auditors don't lose sight of their role as gatekeepers.
Yeah. And then, so let's start. I think he had a lot of commentary on some specific areas. So some area that he had specific comments on was around just cash flow reporting. He's talked about cash flows in past years. But here, he reiterated that the statement of cash flows should deserve the same level of attention and rigor as other financial statements. So the income statement, balance sheet. I think some people view the cash flow as kind of the forgotten statement sometimes. It's usually the last one to come together, I feel like, for a lot of companies. But he really harped on it, I think, again this year. So definitely a recurring theme that we've seen, correct?
Yep, it is. So, cash flow classification continues to be a focus in SEC comment letters. Munter emphasized that companies must ensure consistency in how cash flows are classified across periods. Also disclose any significant judgments. So, for example, when determining the predominant source of cash flows for transactions with multiple components, and then also strengthen internal controls over cash flow preparation. So for companies, this means reviewing the cash flow statement proactively, particularly for complex or hybrid transactions. And if you're making changes to classifications or disclosures, you need to be transparent about the rationale behind that.
Yeah. And he also addressed other challenges in accounting. And so one of those areas was around complex financial instruments. So the conversation around warrants and even, going back to the crypto conversation, a lot of crypto linked contracts we're starting to see more of. And so OCA, did highlight that they are getting a lot more consultation requests from companies that are struggling with how to navigate some of that accounting. I know that's an area you actually spend a lot of time in here at Embark, assisting our clients as well in some of these complex arrangements. But some of the topics or questions, I guess, that come up in those conversations that he highlighted is companies really struggling how to determine the classification of a lot of those complex instruments. So whether they're a liability or equity under ASC 815, also going through kind of the indexation guidance that relates to a lot of those contracts. So contracts that are indexed to an entity's own equity and some of those provisions as well. And I think this is where Munter was really kind of echoing the sentiment that we need more standard setting maybe in this area, that there seems to still be some diversity in practice and interpretation for how preparers are maybe dealing with some of these more complex instruments and some of the features that are embedded in some of these instruments. So I think that, I don't think it's nothing new that we don't see. We do see quite a bit, and I think that's a continued struggle. We know clients here at Embark struggle with when they have these arrangements. But one thing OCA, I think, was also real transparent about was that, hey, if you're a public company, you're dealing with these complex arrangements, don't hesitate to try to reach out to us and consult with us and let us help you guys kind of think through that. And I think it's also encouraging that OCA is really kind of echoing the sentiment like, hey, if you need help, one, you could talk to your auditors, see if they're willing to kind of provide some guidelines or some direction on their viewpoints there, but also, reach out to the SEC. There is a lot of gray in some of this accounting, particularly if you're an entity that doesn't deal with this very often and now you find yourself struggling with it. I think it's great to hear that they're kind of opening the door to let people know, let us help you kind of navigate some of this. And then obviously companies, as they come across these arrangements, need to make sure, just from a preparation perspective, that well documented rationale, reasons, assumptions that are made, just to really understand some of the accounting conclusions that you come to, just in case there is later on questions either from your auditor or the SEC on how you made an accounting conclusion. So I would say, segueing from the complex accounting, I think a more broader topic that Munter's talked about also in the past is around just kind of the ethical environment, ethical behaviors of the accounting profession and practice. So here, I think you actually like this terminology here. So we've always heard the kind of the emphasis on tone at the top. I think we've all are familiar with that phrase, but he then kind of took it a step further and said we also really need to be kind of focusing on the mood in the middle. So what was your key takeaway from that?
Yeah, I did like that. It was the first time I had heard that analogy. But look, like, tone at the top sets the expectations, but those middle managers, the people that are closest to the day-to-day operations, they are the ones that are determining how ethics and professional skepticism are applied. And so for companies, this means reinforcing your independence and ethics through training and culture building, empowering teams to challenge assumptions and ask the hard questions.
Yep.
And then lastly, encouraging a mindset for investor first thinking, like at every level of the organization. One other theme Munter also acknowledged was the talent shortages facing in the profession, something that we're hearing more and more about as the years kind of progress. He cautioned the capacity constraints and performance pressures that, can lead to poor decisions and compromised independence. So on this point, he encouraged companies and firms to ensure workloads are manageable, that resources are adequate, and that teams are set up for success. Overburdened staff cannot deliver the professional skepticism or quality that investors are expecting.
Yeah. No, good points there. So let's then jump into kind of another SEC division here. So the division of corporation finance, so Corp Fin.
Another favorite
yes.
of ours.
And I think once again, a lot of the conversation here was not necessarily on new things. There were some elements of some new discussions on some new rule making, but they did kind of go back to a lot of recurring themes I think we've heard before. So non-GAAP measures and segment reporting were front and center this year. And like I said, kind of a repeat on some of those from past years. But I think it is, a consistent theme we hear from them is them again doubling down on the need for improved transparency and really providing investors that investor grade information so that they can make useful decisions. Thoughts there?
Yeah, so they did emphasize their ongoing scrutiny of non-GAAP measures, and like you said, that's been a focus area for previous years as well. And really now they're layering in greater expectations around segment reporting under ASU 2023-07.
Yeah, so the new segment reporting standard that came out last year. So let's dive into the non-GAAP measures first. So they did remind us that, obviously non-GAAP measures are fine, right? Companies are using them, have all used them historically for years, but they reiterated again that there is specific regulations and rules around the use of non-GAAP measures. So again, re-emphasizing that. So, Regulation G and SK Item 10E, keeping in mind that companies, if you're going to use these measures, you got to align with the rules there. And obviously, again, that's just to prevent, misleading or overly complex disclosures that really don't serve investors' purposes.
Yeah, so let's kind of unpack some of the key reminders for companies on this. So the first is quantitative reconciliation. So non-GAAP measures must be reconciled to the most comparable GAAP measure. The reconciliation must be clear, prominent, and easy to follow. Secondly, you've got to avoid cherry picking. So adjustments need to be consistent and not just one-sided. So for instance, excluding unfavorable items while including favorable ones is a red flag for the SEC. And then lastly, it was really around labeling and presentation. So non-GAAP measures cannot overshadow GAAP metrics. So if you are presenting non-GAAP GAAP metrics must come first, and the disclosures must explain why the measure is useful to investors.
Yeah, and I would say adding on to that conversation around non-GAAP measures, the SEC also indicated that they're starting to crack down on companies that are using a lot of just generic boilerplate explanations when they're explaining their non-GAAP measures. So I think the reminder here for companies is you need to tailor those disclosures to your specific facts and circumstances. So, for example, like take a company that maybe adjusts earnings to exclude certain restructuring costs. Here, the SEC, would expect clear disclosure on why those costs are excluded. Are they truly non-recurring or unusual? And then how that exclusion actually helps investors better evaluate a company's performance. You really kind of have to reconcile those two questions. So companies do need to be careful. I think that's always a message they're arguing, is that if you're going to use non-GAAP measures, just be mindful of it and careful. Also make sure that if non-GAAP measures are included in the footnotes of the audited financial statements, then again, those are going to be subject to your audit and your auditor's review. So just, understanding kind of the purpose and presentation of those non-GAAP measures, I think, is important. All right, so let's move on to another topic that we mentioned CorpFin focused on, which was around segment reporting. Yep. So the SEC staff made it clear that the new FASB standard, ASU 2023-07, is going to be a focal point for them moving forward, right?
Yes. So segment reporting has been evolving to provide greater transparency for investors, and the SEC, like everything else, wants to ensure compliance. So under the new standard, companies are now required to disclose significant segment expenses by reportable segment, and then also provide at least one GAAP consistent measure of segment profit or loss.
Yeah, that's right. But the standard does get a bit tricky because companies often provide additional segment measures, and they're all and this the standard actually allows for them to apply segment measures that could qualify as a non-GAAP measure. So you may see things like adjusted segment EBITDA or something similar to that, which obviously is not a GAAP measure. So the SEC did clarify for companies that are using those measures under that FASB standard that they would qualify as a non-GAAP measure.
Right. And so if they are non-GAAP, you must follow the same rules that we previously discussed. So for companies, the key questions here are: what measure does the CODM use to evaluate the segment performance? Are those measures being consistently applied? And then if additional non-GAAP measures are being presented, are they reconciled and explained clearly?
Yeah, no, I think those are great points. And obviously there's a lot more to unpack around segment reporting. And we've actually done a previous Accounting Matters podcast episode on segment reporting when that new standard came out. So definitely encourage our listeners to go back and listen to that to get further insights on that standard itself. But speaking of standards and the FASB, obviously the FASB does attend the conference as well and provides an update. So let's turn to them for a moment here. So Chair Richard Jones, in a separate session, gave an update kind of on the key projects that the FASB has on its radar. And they did have quite a bit to say and cover here, right, Nicole?
Yeah, they sure did. So between updates on current projects, invitations to comment, and discussions on where the FASB is headed, it's clear they're looking to the future and they want stakeholders to weigh in.
Yeah, so let's start with the big picture here. So Richard Jones, FASB chair, emphasized that, I think he was trying to set kind of an overarching message that stakeholder input really does help drive the board's decision making. They're not off on an island just deciding what they think is best. They really value that input from companies. So he did make it clear that outreach isn't just about checking a box. The part of the reason why they do all this outreach is because they really want to understand the challenges that not only preparers, investors, but other stakeholders and the like are facing when it comes to accounting and reporting.
Exactly, Adam. So Jones noted that the FASB's decisions are shaped on extensive feedback, and that's because they want really thoughtful insights to ensure that the new standards are both effective and manageable.
Yeah, right. And the FASB, they've kind of helped make that more manageable for people wanting to provide that feedback. So they've staggered and extended some of the comment periods for exposure drafts and things of the like, just to give stakeholders more time to be thoughtful about their responses and be able to provide those responses. And I think that's important because, we'll talk a bit about some of these projects here, but if you actually kind of go to the FASB's website and just look at a lot of the activity, especially in this kind of the last quarter of 2024, there's several projects that they've been juggling and kind of moving through the standard setting process. And I think, companies really should look at what's on their radar, and if it's of interest to you, if it has an impact to your business, they really should take the opportunity to have their voices heard and propose. So whether it's on proposed standards themselves, or sometimes they will issue these invitations to comment, or even just about their kind of future agenda consultation process, the FASB is really encouraging companies to share their voice there. And when he's, I think Jones really reiterated that when stakeholders are providing feedback, kind of think about it in two broad categories. So one, thinking about are there any ramifications or unintended consequences of any of the proposals that the board's putting forth? And then also thinking about, specifically on some of the standard setting, is the guidance overly complex to apply in practice? How could we make this better?
Yeah, and that really forces stakeholders to think critically. So not just about what they like or dislike, but about how workable the solutions are. Companies need to kind of move beyond this, we don't like this, to actually proposing actionable alternatives. So it's one of those that's speak now or forever hold your peace, right?
Yeah. So let's, so I think good sentiments there just on the broader, get involved in the standard setting process. It's not a black box that, companies don't have influence particularly on. You can be a part of that process. But let's maybe dive into some of the new standard setting that they did highlight. So one of the new standards was on the disaggregation of income statement expenses, or DICE, as a lot of people are calling it. Long time coming here, right?
It has been. Investors have been asking for more transparency into the composition of operating expenses, and the FASB delivered. Under the new ASU, companies must disaggregate significant expense items like cost of sales and SG&A into key components. The standard was scaled back from earlier proposals, but implementation will still require significant effort for many companies.
Yeah, and we've actually just released a blog on DICE, kind of walking through more of the specifics of the requirements of the standards, but also a more comprehensive kind of next steps and what companies should do to prepare. But just a couple items to maybe just highlight on preparation. We're telling clients that are wanting to already think about it. I know there's a couple years out on the standards actually effective, but some companies are already just thinking about the impacts today, or for those companies that maybe want to early adopt. One is, assessing your current systems, just making sure you understand how your current systems are capturing and reporting expenses, at what level of detail. If it's a very manual process, or there's elements of manual processes in there, you may create some challenges there. So maybe just looking for ways to build some efficiencies. Engaging cross-functionally is important. So working with finance, accounting, IT teams to identify those gaps and implement changes. But then also just around communication, proactively discussing these changes with your investors and auditors so that there's just no big surprises as you're kind of navigating through the implementation. But like I said, we've got a lot of great insights in a recently released blog on this topic, so encourage people to definitely check that out. The other area that the FASB has a project focused on is around the statement of cash flows. And we already talked about that. It's one area that I think stakeholders are very vocal about. You mentioned, and I just talked about, Paul Munter. He loves the cash flow statement, and he's also been, pretty vocal about it as well, saying that the statement itself clearly critical, useful for investors, but we need some more consistency there.
Yep. So the FASB's research project on this topic is really looking to improve classification. So there's ongoing diversity in practice for complex transaction and kind of where they fall in the statement of cash flows. And then also around information on non-cash activities. Investors are really wanting better visibility there as well. Yeah,
and I think, kind of echoing back to Munter briefly, I think he's brought this up too around just the the format of the cash flow, the direct versus indirect method for how cash flows are presented. I think 95, 99, I don't know, almost everyone I've
Maybe
seen
100.
uses the indirect method. And I think it's because some investors have argued, and even preparers probably, that going the direct method route isn't worth the effort. But I think there's the counter argument that the direct method does provide more granular insights into a lot of cash flow activities that you may not be able to pull out as easily from the indirect method.
Yeah, and I think this is one area where companies really should be weighing in if they do have a strong viewpoint on this. If the direct method does not provide additional value, you got to make that case very clear. Also on the other hand, if more detail would improve investor understanding, companies need to explain how that could be practically achieved.
Yeah. So again, here, if your cash flow is top of mind for you, kind of keep an eye on that FASB project. Again, feel free to engage with the FASB when they are soliciting feedback on any targeted improvements or changes to the cash flow guidance. Like I said, just something to maybe have on your radar, because I think there's always instances, I think, where we're making small improvements to cash flow guidance, and it seems to be there seems to be more kind of rapport around that right now.
Yep. And I think one more thought-provoking topic that was discussed was around intangible assets. Mm-hmm. Specifically, the FASB is issuing an ITC to gather feedback on two big questions. The first being, should there be one accounting model for all intangibles, or should we maintain the multiple models? And then secondly, should the method of acquisition, meaning internally developed versus acquired, result in a different accounting outcome?
Yeah, and that's, big question, definitely, right? If you think about currently internally developed intangibles, so think about research and development type things, right? Those are, basically often expensed, while on the contrary, acquired intangibles are capitalized. So it definitely is a difference that I think has been a point of frustration for some stakeholders and some investors, just to understand that, because obviously that can create comparability issues in some cases. Mm-hmm. And then especially if you think about more innovative kind of industries like, tech or pharma, there's a lot of internally developed intangibles, you could argue, that exist. Yep. So the ability possibly in the future to capitalize some of those could really kind of just shift the overall dynamics of their balance sheets quite a bit.
Yeah,
so
it would.
Again, here, I think, there's an invitation to comment. If this is a hot pressing topic for you and your company, your business, definitely, take the time to weigh in, right? That's why they're issuing that invitation. Yeah. So think about whether a single model would improve comparability, how those changes might make your financial statements more useful for investors and other stakeholders. And then also just thinking about some of the operational challenges of, on the contrary, if you are going to start to value some of those internally generated intangibles, obviously there's going to be some complexity there to figure out what those are. All right, let's close out, I guess, our FASB topic then on the last kind of area that they highlight. Well, probably not the last they highlight, but the last we'll touch on today, which is around financial key performance indicators, or KPIs. So kind of piggybacking off the last invitation to comment, that FASB also issued one here asking for stakeholders' input on this, right?
Yeah, and the question here is, should KPIs, both GAAP and non-GAAP, be standardized or required in financial statements? Which is actually an interesting debate the more you think about it. So on one hand, standardization can improve consistency and comparability across companies, but on the other hand, KPIs are often tailored to specific industries or business models, which could make it tough to really standardize. So companies should be thinking about what KPIs are most relevant to their business, and investors, how are they currently calculating and disclosing those KPIs, and then would standardized KPIs add clarity, or could they create more confusion? So again, here is another opportunities for companies to shape the conversation. Thoughtful feedback can help the FASB strike the right balance between flexibility and comparability.
Yeah. All right. So then let's shift gears to the last kind of topic or segment we've got from the conference. And this was really centered on a number of emerging topics, I think, that were talked about throughout several sessions. So things around artificial intelligence, crypto, and then again, ESG reporting. I think we're seeing many companies are facing risks, opportunities, and increasing regulatory expectations in all three of those areas, right?
Yeah, so between the SEC, the FASB, and even the PCAOB, it's clear that AI, crypto, and ESG are top priorities across the accounting and reporting landscape. I think there's no debate there. The tone of the discussions made one thing clear, so companies can no longer afford to take like a wait and see approach. So let's start with AI.
Yeah, so AI, I think no shock here, it's been a game changer across almost every industry probably at this point. But the SEC staff did caution against boilerplate disclosures and about how companies are using AI. So Nicole, this has become a theme again in recent comment letters, right?
Yep, they touched on that. And so the SEC is really specifically focused on AI related risks and governance structures. So companies that are integrating AI into financial reporting, data analytics, forecasting, and decision making, but often the disclosures are lacking specificity.
Yeah, and that's a problem, right? If a company says we use AI to enhance operations, but doesn't explain how AI impacts performance, risks, or controls, the SEC sees that as insufficient. So they're wanting more clarity around how companies are deploying AI, particularly in their financial reporting processes, what governance structures are in place to help manage those AI risks, and then how is AI-driven processes impacting financial reporting outcomes? So, for example, companies using AI in forecasting need to consider, like, are their models transparent? How are they validating the reliability and completeness of any AI outputs? And then, you can't lose the human element here. So what role does human oversight have in potentially, like, challenging some of those AI assumptions?
Right. And then there's also the issue of bias and data integrity. So AI is only as good as the data it's trained on. So companies really need to be ensuring that their data governance process is robust to avoid unintentional errors or misleading financial outputs. The SEC is also looking at broader ethical considerations. So companies need to be clear on what steps they're taking to ensure AI-driven tools comply with industry standards, regulations, and ethical guidelines.
Yeah. So what's the takeaway for companies? So I think, again, it's enhancing those AI disclosures, right? Really explaining the impact AI has on a company's operations, reporting, and risk management. Again, let's avoid the boilerplate language. They've harped on that several times in several sessions. Strengthening your AI governance at your organization. So, internal controls being implemented to validate the data, monitoring model performance, and then understanding how you mitigate risks like bias and errors, like you mentioned. And then again, I think it's around just being transparent with, like, the proactive communication to investors and auditors. They're the ones looking for confidence that any AI-driven processes that you have are reliable and there's appropriate governance around those. All right, so let's go to the second emerging topic, which we touched very lightly on at the beginning, was around crypto. That's been something that the SEC has been focused on for a number of years, as we've seen kind of a growing kind of demand and just the relevance of crypto in businesses across all industries, really. And so the discussions at the conference reflected a growing sense that companies need clarity and fast around crypto. So the SEC and the FASB, right, they've been tackling a lot of crypto-related challenges. I think one thing, they did reiterate is that there still isn't, like, a perfect rule book for, navigating kind of the crypto world.
Yep, that's right. So, for example, one area flagged by the SEC was crypto custody risks. So if your business involves digital assets held by a third party, companies must clearly disclose who controls the assets and any related risks, evaluate whether those assets should appear on the balance sheet, and then strengthen internal controls over crypto transactions and reporting. The bottom line is crypto isn't just a niche issue anymore. Whether you're investing in crypto, accepting it as payment, or holding it on behalf of others, regulators are expecting robust policies, governance, and disclosures.
Yeah. All right, so let's wrap up the last emerging topic, which is around ESG reporting. I know we've talked about it in a number of episodes on this podcast. And I think, one thing here is that, and we've said this before, that ESG is no longer just a nice to have. I think absent what happens with the SEC rule, I think investors are demanding quality and transparency in that information, and companies need to be able to keep up with that demand.
Absolutely. ESG reporting has reached a critical juncture. Globally, the frameworks like the EU CSRD are raising the bar for mandatory disclosures. And so while the SEC's climate rules are delayed, investors are still expecting companies to provide meaningful insights. And then also ESG reporting often suffers from inconsistent data and weak controls. So companies are realizing that they need to apply the same level of rigor to ESG data as they do for financial data.
Yeah, and that's really key. ESG reporting isn't just about checking boxes anymore. It's really about aligning those high quality disclosures and information with the company's overall business strategy and investor needs. So again, I think this was reiterated by some of the practitioners, as well as some of the preparers in sessions here, that companies really need to be focusing on, and these are things we've harped on as well. One, materiality assessments, right? So what ESG factors are truly relevant to your business and for your stakeholders? Two, again, around that data integrity. So looking at controls, do you have the right ones in place for completeness and accuracy of your ESG data and metrics? And then integration, right? Like, how does your company's ESG story tie into the broader financial or kind of operational story of the business? And then the last one's around integration. So really, how does ESG reporting tie into the broader financial story? So for example, like, how does climate risk maybe impact your company's ability to generate revenue or meet revenue projections? Or how does that potentially impact asset values? Just some things to think about there.
Yeah, and the SEC also flagged concerns about greenwashing. So where companies actually overstate their ESG commitments without substance to really back it up. So companies do need to ensure their ESG reporting is credible and supported by the data.
Yeah, great points. Companies need to be making sure, right, that they're not over-promising and under-delivering on those commitments.
Yep.
Again, controls and assurance and the data that's being presented, and better aligning that ESG reporting with your financial reporting to tell that cohesive story. So,
yeah, and so I think the key takeaway here is clear. Investor expectations around ESG reporting are not going away. Companies that embrace transparency, data quality, and a principles-based approach will be better positioned for the future.
All right, so let's wrap this up here. So, Nicole, maybe just quick question to you. What's your kind of overarching takeaway from this year's conference?
I think it's about proactive preparation, right? So you've got to stay ahead of the changes in regulations, standards, and emerging risks.
Yeah, well said. There's definitely, I think, a lot for companies to consider, a lot of things on the horizon, a lot of new changes that have already happened. So a lot to juggle there. So I would definitely echo that proactive preparation. It will be key going into next year and even beyond. So thanks for walking me through this, joining me in this conversation.
Yeah, of course.
It's exciting to be back in the podcast booth with you.
Yeah, dusting off the mics a little bit.
But for our listeners, we appreciate you guys also joining us on Accounting Matters. And don't forget to catch us on a future episode. And if you haven't already, subscribe to the podcast so you don't miss an episode. And we'll see you next time.